I'm your host, Effie Pilarino, and today I am linking with Craig Iskowitz. This is not the first time that we meet virtually and connect. Craig is the CEO of Ezra Group, and we'll hear more about Ezra operating in the wealth tech sector. You will tell us more, Craig. Welcome.
Effie, it's wonderful to be here. Oh, wonderful to see you again. It's been a while. Thanks for having me on the program.
Well, thank you. I mean, I watch often your program, your podcast, and I learn a lot about what is going on in wealth tech in the US, which of course is a much
thank you so much.
Yeah, well, it's a much more mature market, and with your specialty, tell us briefly what Ezra is focused on.
Thanks for asking, Effie. So Ezra Group, we are a consulting and research firm in the US. We've been around 17 years, and we focus primarily on wealth management technology. So half our clients are banks, broker-dealers, asset managers, large RIAs who want help with their technology strategy, improving their operational systems, doing RFPs, implementing new software. And then the other half of our clients are fintechs or wealth tech firms. So the firms that support those clients. So we work with all the biggest vendors in our space, and we help them with product strategy, roadmaps, competitive analysis, partnership analysis. We do some M&A work, some due diligence. So it gives us a broad range across the industry.
Great, very interesting. So I guess you have quite a 360 view of the wealth tech sector in the US, which again
I'd like to think so.
Yeah, great.
And most companies do not. Most companies, like in our space, do one or the other. Either they work with the client side or the vendor side. We do both. So I think that gives us visibility into things that many other firms don't see. It helps us deliver better value to both of our client segments.
So would you say that during the COVID situation, wealth tech accelerated? Because I think it was one of the subsectors of fintech that was relatively behind in terms of all metrics, be it funding, be it unicorns, be it M&A on all fronts compared to other sectors like payments and lending and all the banking, consumer banking sectors.
We saw some interesting changes during the pandemic. One was a couple of our big broker-dealer clients put projects on hold in order to readjust their priorities. But then a lot of fintech clients came up with new projects, which is, again, good for us. We have both. So a lot of fintech firms realized, hey, this is a great opportunity for us to leapfrog our competition when things are kind of in upheaval. What can we do? We have a new product. We want to go to a new market. A lot of our clients either want to move into a different space. So let's say they work very good with small companies. Now they want to work with enterprise. So we work with those types of clients, or the vice versa. Hey, we're really good with enterprise space. How do we work with smaller firms? Or they want to come into go into a new category of clients. Maybe they sell to in the wealth space. Maybe they want to go into other aspects of it. They want to sell to asset managers or other types of firms, or they're firms that are outside the U.S. and want to come and break into the U.S. market. Mostly Commonwealth countries come to us, so UK, Canada, Australia. We do have some clients in Singapore, Hong Kong, who are looking to come to the U.S. as well. But that's what we saw an uptick of during the pandemic.
Interesting. Recently, Craig, what caught my attention is that you launched the so-called WealthTech Integration Score. And I think it speaks, the title speaks for itself. But I want to hear from you, first of all, why did you launch this? What was the need? Where did you see the need? And of course, a little bit about what it does and how it serves your clients.
Thank you for asking, Effie. Yes, we launched the Ezra Group WealthTech Integration Score last month, and it was many years in the making. So I've been in financial services over 30 years, and it's always been a problem integrating different technologies. Excuse me. If you remember a long time ago, back even in the 80s, integration was horrible. We had these different kind of plugins. Microsoft was plugins of things. You could plug in an Excel spreadsheet into a Word document, and that was revolutionary. Hey, we can do this. This is great. But moving data between systems was almost impossible. We came up with the file transfer function where you're dropping files into different directories, and that's pretty much stayed the mainstream integration tech tool for 30 years. Is just dropping files, and they're still doing that. There's still a lot of companies sending files back and forth. We kind of migrated slowly into direct communication between applications, first on local servers. If you had everything on locally on your server, then maybe those tools to communicate, but only inside the same box. When we moved to the cloud in 2000s, when the cloud computing became more popularized, then it became easier to communicate directly between different applications, even if they weren't in the same physical location, because you're in the cloud. And that's come to pass that we've seen more and more of that, but it still doesn't work quite well. It's still opaque. It's still hard to know which vendors integrate with other vendors, and when they do, what actually you can do with that information. And as consultants working with both sides of the business, we've seen everyone's problems. We hear from the clients, we can't make this stuff work. The vendors told us it was going to work. It doesn't work the way they say. They claim they have this, they don't have it. And we work with the vendor side saying, we built all these integrations, no one using them. We don't understand how to get this to work. So we decided to come up with some way to help. And the Ezra Group WealthTech Integration Score was one part of the answer, where it is a single number that gives you an evaluation of an application's capabilities around integration in our space. So it's 0 to 10. So the higher the score, the more capabilities they have, the more systems they integrate with, and the more depth of integrations they have. So that was also important. So that was the reason why we did that, to provide some transparency, to make it to give a tool to help our clients and our vendor clients better understand who to partner with, and what software to buy when you're making these kind of decisions.
So is this score a relative score, meaning that if I am a business and I have my applications, and it's within a specific environment, can this score tell me what matches or what integrates easier to my environment, or is it a general score?
It is a general score at the moment. Right now, it's a general score. We have 3 criteria we use. One is breadth. So how many integrations you have, and that's relative to each category, whether you're financial planning, CRM, portfolio management. Inside that category, you have a relative number of integrations, and it's ranked in that category. Then we have the technical category, which is we call it the technical support category, which is, do you have APIs? If you have APIs, are they documented? Do you have source code available for people to use? Do you have a SOC 2, which is a security registration or security testing? Do you have a penetration test? Do you have a sandbox for developers to work in? So all these different things you need when you're building with integrations with APIs. That's 25% of the score. Then 60% of the score is depth, because we really want to focus on deep, meaningful integrations. We don't want firms to say, well, I built 100 very simple integrations, give me a great score. No, you won't get that. You have to have deep, meaningful integrations with a core of applications that are the most popular applications in the US in each category, whether it's planning, CRM, reporting. So you have to integrate with that core that gives you a higher depth score and have more meaningful. So an SSO, which is a single sign-on, is a level 1 integration. You get a score of 1 for that. And an embedded widget that you just kind of flip on with a configuration, that's a level 5 integration. So 1 to 5 each integration you have, that adds up into a score for depth. So the goal there is doesn't tell you, that score doesn't tell you who you integrate with. That's another level of data we have available. It just tells you, in general, this company integrates with the top 40 applications very well, very deeply, has a lot of other integrations, and they're very well supported.
Interesting. I mean, what I'm seeing, Craig, is that especially incumbents are in this phase of integrating internally with all the capabilities and the silos of the businesses that they have. And I can imagine that this is also the case with fintechs and other type of partnerships. So this type of score, is it useful for a big incumbent like, I don't know, Bank of America, looking at its wealth management capabilities and how to integrate it, or not so much?
That's exactly who this is targeted at. The larger the firm, the more usability you have, the more functionality you get out of the score. Because the larger companies tend to have more integrations. They tend to do more internally. They tend to build more of their own. And they're the ones who are feeling the pain the most because they're building custom integrations with lots of different vendors.
Very interesting. Very interesting. I mean, I always think of this API-fication, which I tried to allude to before we started our recording, and it isn't an easy word, but it's really about all the preparation that is needed to start the journey towards embedded wealth. Are you seeing that we are starting that journey of embedded wealth? And when I say embedded wealth, either in financial services that have not been in wealth at all and now want to get into wealth, but want to do it as a service through embedded wealth, or non-financials, a retailer or anybody like a marketplace that has merchants and wants to offer wealth services, wealth management services embedded. Are you seeing that? Is that something that clients are discussing or are building towards?
That's the ultimate goal. I think we've already seen banking as a service and lots of other applications as a service, again, because of the cloud-based infrastructure that's become ubiquitous. We haven't seen wealth management as a service yet, but it's coming. And I look at things more holistically, and I've been a proponent of everything in one place. I don't understand why, in the US, you have to go to an investment advisor for your assets. You have to go to an insurance agent for your life insurance. You have to go to a CPA, an accountant for your taxes. You have to go to a trust estate attorney for your trust, and they're all separate. Why aren't they all the same place? So I think you are going to see more embedded wealth in non-areas, like, for example, Uber drivers. Uber is going to start offering IRAs to their drivers, and that will be embedded in the app. You use an API to get that. We are seeing some mobile apps doing similar things where they're coming at the problem from different angles. If you look at a company called MoneyLion, which has got about 4 million clients in the US, they started out lending and banking as an app. And then they moved, once they got successful, then they started adding investment advice and services. So they came at it from that point of view, whereas a company like Acorns did the opposite. They started out as a budgeting, spending app, added investment, then they're adding lending and banking. They added a checking account. So everyone's kind of coming to this, more the mobile startups are seeing, hey, we want to be holistic. We have to have everything in one place on one app. So they're sort of leading the way there. But I think now that more firms are offering APIs, you can see there'll be some firm that comes up and says, we have to embed this somewhere, and it'll just become a domino effect, I believe.
I mean, SoFi is also another good example, similar to what you mentioned before. Is SigFig, which is B2B now, really one of the front-running players that might be providing those types of services?
No, I mean, SigFig is a B2B digital platform where they build digital advice services for large enterprises. They've got a couple of big deals. So the market share is very difficult to come by in our industry because people play it very close to the vest. Nobody wants to talk about. So we kind of try to maintain our own. But you have to look at market share in a number of different ways. One is number of seats. So how many advisors are using it? Number two is, what are the assets on the platform? Number three, how many clients there are. So those can be very widely different depending on where they play. So with a SigFig, I know they've got some deals with Wells Fargo and UBS, so they may have a very large number of assets, large number of advisors, but other firms that compete with them, like IntelliFlow, which bought GemStep, that was a digital onboarding tool, and some other tools may have more individual clients spread out in different areas. So it's hard to tell, but they're all doing interesting work. They're all trying to provide better services for clients and make it easier to launch what I call self-directed investing. So where the investor does a lot of the onboarding and does a lot of the management, but then it's still the same back end. It's still the same models. It's still rebalanced. It's still reported on the same way. It's just there's no one in between that and the client.
Interesting. So self-directed investing is a big sort of chunk of the US market. And you think of it as, do you think of it as different than do-it-yourself investor?
Yes, much different. Yeah. So looking at when I do I partner with Michael Keatsis on a map called the Financial Advisor Tech Solutions map, which you can find at keatsis.com. And we have all the different categories of advisor tech solutions. So digital onboarding is where SigFig would play. I was just looking at my list. So when I mentioned the firm, IntelliFlow owns a company called GemStep. There's other firms, Advisor Engine, Marstone, that also do this digital onboarding. A company called Harvest that's now owned by Envestnet. So the digital onboarding is very different than self-directed investing. When you're self-directed, you are just going to E-Trade or another online broker and making all your own trades. So you're doing everything yourself. When it's digital onboarding, it's just the part of the getting the client onto your system, that the client is doing that all themselves. Once they're onto your system, once they're set up as a client, then you're handling it all with most of the same technology that your advisors use, right? No advisor rebalances by hand. Very few, too many advisors pick their own models, but advisors in firms where they have a home office-based investment management strategy don't pick their own models either. The clients are asked a bunch of questions for risk tolerance that puts them into a model. And so that's all done the same way in a robo-advisor, whether you're digital onboarding through Marstone or Advisor Engine, or whether you're going to, or whether you're doing it through an advisor, you're probably getting a very similar
model portfolio framework.
Correct.
Yeah. It's
That's becoming ubiquitous now. 5 years ago, 6 years ago, we were doing projects with some of the largest broker dealers, and they were not digital. All their onboarding was paper. They were mailing 100-page files back and forth overnight. But since in the last 6 years, a large percentage of broker dealers and RIAs have moved to digital onboarding. So it's become ubiquitous. It's not a standalone category as much anymore. We still keep it standalone because there are some firms like a Marstone, Advisor Engine that do that, but they've also been expanding their capabilities. So there's fewer and fewer targeted standalone firms in this category. They've either been acquired or, like Advisor Engine, have built out more capabilities to become almost an end-to-end platform in themselves.
So essentially, this is no more any type of differentiation, this digital onboarding anymore, right? So what do
it's tough. I mean, it's a very narrow focused. I mean, there's still some firms that need that, like Marstone signed a deal with not UBS, but First Boston, CS First, Credit Suisse. So no, HSBC, sorry. So Marstone signed HSBC, they wanted digital onboarding. So there's still some large firms that are looking for a standalone vendor that they can integrate into their systems, which you mentioned earlier about integrating internally, and enterprise firms like Bank of America, what would they need? So there's a lot of different options for them. Sometimes they want an all-in-one solution. If you look at some of the largest broker dealers in the US, many of them choose a company like Envestnet, which is an all-in-one solution. But some firms say, look, we want to pick and choose our pieces. We want to build our best of breed, and we'll take a piece from here and a piece from there. And they rely more on integrations, and they love our integration score. They've been calling, our phones ringing off the hook with these larger firms saying, can you give us the underlying data? Because behind the integration score, we have 4,000 integrations, right? Every vendor might have 50, 60, 70 integrations. Each one of those is scored. So you can see all of that across. So larger firms like a Bank of America, or like a Wells Fargo or UBS, they have dozens, if not hundreds of integrations. They have dozens, if not hundreds of internal systems, right? So they're very, very complicated environments. And even their internal systems don't talk very well. So having this integration score, where it's providing, so we're seeing it being very valuable, and we're getting a lot of calls from these enterprise firms to get more in depth for them.
I can imagine. I can imagine. And as you said, I mean, I can only think, Craig, that you will eventually have sophisticated tools to visualize this data, because it's really, it gives you, it can give a big company with so many integrations a full visual of what is going on that is very difficult for them even internally to have.
Indeed. I mean, some of the bigger companies can afford to do that, but some of them haven't, because they don't really know what integrates well across different applications. They know what they work with. Like, because remember, when you're building an application, you don't look at every single thing that the vendor can do. I don't want these specific things. That's what you work with. So you don't know the other integrations available. You don't know what the other APIs that and what they can and can't do. So we're building all that into our database. So we'll know every vendor, all their APIs, what data they can receive, what data they can send. And that'll be one big directory. So for larger firms to say, hey, we're thinking of building out a new reporting tool. We're thinking of building a new advisor dashboard. What's available to us? Right now, you have no way to know. So it's very hit or miss. With our data, with our directory, and of course, we would sell that information to these firms. They can look across all the vendors. There's almost 400 vendors in our space that are stored on the Kitces Ezra advisor map. That's a lot of data. And if you could see that in one place, you would easily say, oh, okay, this vendor integrates well with this vendor. Oh, and this one's with vendor A, vendor B, vendor B, C, vendor D. Let's go in this direction. So that would save them tremendous amounts of research on their own.
I can imagine. And most importantly, they know really what they're going to face once they build. They won't have any bad surprises if all these integrations are accurate. And I imagine,
well, that's our next step. If I can interrupt you, Effie, I'm sorry. But to that point, our next phase of our research is reaching out to clients and saying, okay, Mr. Vendor, you gave us this, we gave you this score based on what you told us. We're not going to validate that. We're going to give us a client or two that we can now call and say, did you integrate this? The vendor says they've got this level of integration. Does it work? How hard was it to integrate? Did it go the way they said it went? All right, so that's the next level. And with 400 vendors, it's going to take a while to do that. But once we work our way through that research, then we'll have actual on the street or actually hands-on results of, yes, these integrations work or they don't work. And then we would change the score, right? If we say, hey, vendor, you told us you've got integration to Redtail as an example. Well, we talked to a couple of your clients and they say it doesn't work. We're dropping your score. And now what will that do? That's going to benefit a lot of people, because now the vendor's got to fix it, because, and now everyone's going to know the score went down and why it went down. So that's a lesson for other firms. Don't tell people and that's a big problem. I'm thinking a lot of industries with software, with salespeople promise what they can't deliver. So they're saying, we've got integrations, no worries, buy our software. Then you buy it and they don't have anything. So hopefully our tool will flush that out. So less vendors will be able to get away with, we have this integration. Well, it's not here. We just look through the Ezra Group score list. It's not shown there. Well, so they'll rely more on us to validate they have that integration. So we'll become a trusted source for clients who are, again, saving time and money and effort and frustration, signing a deal with a vendor that promised something that they really don't have.
Basically, what you are saying, Craig, is that transparency in this case is really serving the industry as a whole, and
exactly.
This is exactly what you're saying. And I imagine that eventually the further step for you would be to build the connections with your clients so they can, through APIs, automatically update their feedback. And so you have less work and this database is updated continuously because it's in everybody's interest to keep it updated.
It is, and no one's doing this, so we thought that, I mean, clearly we're a for-profit company, so we're trying to make money, but we also see it as a major benefit of a benefit to the industry, that we're encouraging transparency, and we're encouraging vendors to put more on their website, what you have, what works. So a lot of vendors just put a logo. Hey, we integrate with, Salesforce. Well, what does that mean? You integrate with Salesforce. I want to know what data you can send them, what data I can send you, what APIs are available. That should be on your website so anyone can see it without having to sign a non-disclosure or go through a hoop, jump through hoops. Just give us the information. That way everyone can understand what they need to do, whether it's a vendor, a partner, a client, consultants. So we're really pushing for more transparency and more deeper integrations, because our score is very highly dependent on deep integrations with the top 40 or so applications that are most popular in our industry. That's going to encourage exactly that, more deeper integrations with the applications that everyone is using. And we'll start slowly expanding that until you're seeing much more fluid and seamless integrations, because that's what we're encouraging in our score. The more of the plug and play type of things, where you can just drop it in and it works, and that'll benefit everyone in the long run.
100%. I mean, the direction of the industry, any case, is low code, no code. So all these types of tools are extremely helpful. I mean, ratings, transparency, ratings that do not have, inherently conflicting incentives are important, right? And in this case, I think this is a great approach that you have taken, and these are the first steps, and I'm sure that you will have a lot of insights to share with us a year down the road, after this is launched and used by the market. It's
absolutely. I mean, just to that point, Effie, we're keeping detailed statistics on this, and of course, the more data we get and the longer we go on, we'll have more information for you. But for example, right now, our score is out of 10, and we currently have scores out of the 400 or so vendors. We have scores for 298 on our website. With those 298 vendors have a total of 4,364 separate integrations across those 298 vendors. The median integration score across those 298 vendors is 4.3, which is kind of low. So what that's saying is, median, there isn't a lot of integration going on. There's some 10s that are doing great. There's a bunch of zeros that don't have any. So that median score shows that in general, the industry is a little low in terms of the way we measure integrations, that there isn't a lot of depth across the industry. But we can, in the year, I would hope that number to go up to 4.8 or 4.5, right? That would show more firms are adding more deeper integrations. That's the interesting statistic to talk to you about next year.
Yes, I understand. And Craig, before we close, is this something that is done in other industries that you have seen, or not really? Not that you're aware of?
I haven't seen this, no. I haven't seen this particular information in other industries. Not that it may be there, I just may not know about it. I did a quick look around. I couldn't find anything specific. That there's lots of integration data available, but not a score across a particular category of applications.
Very interesting. Well, Craig, thank you so much for all this these insights and information. We will definitely connect soon and get an update. I mean, the industry is definitely evolving, and I hope that the direction of embedded wealth moves much faster, although it is a complicated area, right? We lack standardization, and there's such a variety and segregation of clients, of products, of distribution channels. And although we all want a one-stop shop, we're not close there, are we?
Well, in some areas we are. some things you can get a one-stop shop, but the problem is the definition of one-stop changes. The table stakes increase slowly over time. So what was a unique feature a year ago may be table stakes this year. So that gets rolled into the one-stop shop. And we get asked this question a lot. Should we go all in one or best of breed? And there's no right answer. It depends on what you need, depends on your capabilities, depends on your goals. So we're looking to encourage both, that you should be able to pick either one, and you should be able to build the same type of seamless experience for your advisors and clients. And that's part of how the integration score is going to be helping them. But yeah, we're looking forward to more embedded wealth as a service, better integrations across vendors, better experiences for clients and advisors and other people who are in the industry, whether it's staff, operations staff, executives. Everyone needs to have a more seamless experience and get the information and data they want and have it at their fingertips. And the one thing I would say, and I didn't make this up, I got it from somewhere, but the rate of change will never be as slow as it is today.
I know
The
it.
rate of
Can
change
I
is going faster,
paraphrase
it's
it?
increasing.
Yeah,
Yeah.
I know the same saying in a different way. Today is the slowest day of your life.
Yeah,
Which
right.
is
Technology-wise, yeah.
technology-wise, exactly. Craig, thank you so much. I will share with our audience the links to your podcast and your content and your insights.
Yeah. You can find us at
so much.
EzraGroupLLC.com is our website. Thanks for having me on, Effie.